Uh, Hi, Feroz, are you there? I cannot listen to you. All right, all right. Hello, everybody. This is Mohammed Farhan. I couldn't hear the introductory part from Feroz. I hope everybody can hear me. Feroz, can you confirm if I'm audible?
Yes, you are audible for.
Thank you, Adil. Thank you, Adil. Good evening, everybody. This is Mohammed Farhan from EY. I am part of the EY tax practice here in Lahore. I'm part of EY for past 3 years. I am actually trained as a lawyer, graduated from law school. Post graduation, I have worked at a corporate law firm in Islamabad. After working at a corporate law firm, I switched to tax practice, and then I joined EY Lahore office 3 years ago. So this is second session of the 6-digit series on the Pakistan tax, and I hope I think there are a good number of people who have joined, and I'm sure all of you attended the last session by our senior partner. That was on the introductory part of the legislative tax structure of Pakistan. Today's session is going to be the second of the session, and it's going to be the first session on the tax competition, or the first part on the tax competition. So in this session, we will be focusing on primarily 3 areas. What is the income from salary, how to compute the income from property, and what is capital gain. But before going into this, the 3 heads of income, we will first sort of quickly recap what we discussed in the last session. I will briefly go through or sort of recap what we discussed in the last session, and then we can switch move on to the today's agenda. So if in the last session, for those of you who couldn't join us, we basically discussed 3 major parts. One was the constitutional structure and how the taxes are imposed under the constitutional structure in Pakistan, and the second part was focused on the legislative business and how the tax legislation, either in provincial legislature or in the federal legislature, how that's being promulgated. And in the third part, we sort of focused on the tax structure, the tax collecting authorities, how there are different tax jurisdictions for sales tax, how the income tax is being bifurcated into agricultural income and other incomes other than the agricultural income. And then we sort of quickly went through the overview of the income tax and the sales tax. And when we went through the income tax, so in the income tax, there were 3 major areas that we focused on. The first was what is the taxable income. The other one was who is the person for the purposes of the Pakistan tax, and what is the tax year for which an income tax will be levied and computed. So if you can recall, taxable, the person's is an individual, AOP of the company, and then what is their residential status, because their residential status certainly is a determining factor when it comes to computing the income tax liability for a person residing in Pakistan. Secondly, we focused on what the tax year will be, because in Pakistan, the normal fiscal year that starts from the 1st of July and ends on the 30th of June of the immediately following calendar year. And obviously, that's the normal tax year, but there are obviously provisions for a special tax year, catering to the special needs of the non-natural persons or the legal persons, such as company or any AOP, if there's any special tax here for those. And then we moved on to what the tax regimes there are, because there are two tax regimes in broadly categorized. There are two tax regimes. The one is the normal tax regime, and the other one is the final tax regime. Under the normal tax regime, the income is computed in accordance with the five heads of income, and obviously each head of income, as we will go through today's session, we will get to learn that how each head of income has its own limitations, has its own computations method for determining or computing the taxable income under that head. Pardon me. And then there was a final tax regime that we quickly touched upon. Final tax regime, obviously, it's based on the gross income of a particular transaction or a particular person, and how, and there are sort of fixed tax regimes, and there are no fixed tax rates, and there are no deductions allowed there under for computing income under the final tax regime. In today's session, our focus is going to be on normal tax regime, and in particular, our focus is going to be on three heads of income falling under the income normal tax regime. The first one is going to be income from salary. We will just briefly discuss what actually is salary, how it's been defined, and how there are different benefits which need to be accounted for when we compute normal tax liability under the income from salary, and how one needs to account for different benefits or perquisites flowing from the employer to the employee. Then we will move on to the second head of the income under the normal tax regime, called income from property. I think it's pardon me for saying it's going to be what income from property will be called, any income earning from property. Then we will skip income from business and income from other sources, because these are areas which will probably, income from business in particular would require a whole session dedicated to this particular head of income. So the next session is going to be on income from business. For today's session, we are not probably going to touch upon this, but there will be some elements. If you have any question that you would want to ask, or you are interested, obviously, if those questions relate to today's session, then obviously we would respond to those. But otherwise, we will try to respond to those questions in the next session. The third and the last part of today's session is going to be the capital gains, and certainly an important part of today's session, because we will touch upon what the capital gain is, what is the capital asset, what is the disposal, and how the capital gain is to be computed. So I think we are good to go. We can start our today's session, starting from what constitutes as salary. I think in normal circumstances, or in layman terms, a salary is something that an employee receives from an employer in the course of his employment. but obviously an employee, it's probably going to be a natural person. A non-natural person or a legal person probably would not be be considered as an employee, because of the nature of the interaction between an employee and the employer. Uh, and then, as you can see, salary is an amount received by an employee from an employment. Employment has its own definition within the tax law, so it has been defined as an amount received from employer, which is fixed or ascertainable in nature. Because if it's not an fixed amount, or it's not ascertainable, or it depends on different circumstances on different services, then obviously this would probably not be considered as salary. Similarly, if any director in the board of directors of a company, will be considered as an employment, and any remuneration received from the company by that director would also be considered as salary within the meaning of the Income Tax Ordinance 2001, which is the applicable tax governing the income tax in Pakistan. And so salary is any amount that an employee receives from his or her employer, whether that's being of revenue nature or capital nature. Revenue nature means the one that's the remuneration, the wages, cash, that flows from the employer to the employee, or the capital nature of different benefits or the perquisites that will flow from employer to employee, in for instance, any conveyance that's being allowed. So whether that's being of revenue nature or the capital nature, both will qualify as salary, given that it falls within the definition of the employment. So broader categories of different elements that fall under the salary, as you can see on the screen, is that any amount of allowance that employer is providing to the employee, including any cost of living, rent, entertainment, or travel allowance. However, this would not include allowance solely expended in performance of the employment. For instance, if an employee incurs any expense in relation to the employment, traveling from one location to another while performing his or her job, then obviously that reimbursement from the employer to the employee would not fall within the definition of the salary as under the income tax ordinance, and accordingly would not be accounted for when computing the salary income. Similarly, any remuneration, whether that being leave pay, whether any compensation, any bonus, any commission, fees, or any work condition supplements that the employer provides to its employees, would also be considered as salary when computing salary income. As you can see, there is an underlined category, perquisites. Whether convertible to money or not, we will in a short while we will also discuss with focus on this what exactly are perquisites. In general terms, perquisites are basically any benefits that flows that will be flowing from employer to the employee. Moving on, you would also see different components of profits in lieu of or in addition to any payment of salary or remuneration, including any consideration that the employer would be paying to the employee for merely entering into the employment relationship, any consideration for any change in conditions of the employment that the employer and employee would agree, would also be considered as a salary for this purpose, for tax purposes. Similarly, there are provisions for provident fund and how provident fund would need to be accounted for, and we will go through in somewhat detail when discussing what the provident fund, how the treatment of provident fund deductions and employer contribution will be taken into account under the income tax ordinance. Similarly, we will also go through any amount chargeable to tax as salary under the employee share scheme. Employee share scheme, we will briefly touch upon what the employee share scheme is and how one should account for salary income when employee share schemes are being deployed by the employer. So these are different components that we will go through today's session with focus on provident fund, employee share scheme, what the conveyance allowance is and how that should be accounted for, and then we should also we would also look how the accommodation allowance or any interest free loan will need to be accounted for when computing salary income. So before moving on, there are two things that I would also like to highlight, that whenever an employer would be undertaking the liability to pay the tax on salary, in essence, on behalf of the employee, that will be accounted for as a benefit from the employer to the employee, and then eventually employee would have to account for that benefit, and any differential amount that will be payable in terms of tax will be paid by the employee. I will probably not have a concrete example on this, but I will discuss this in somewhat detail in terms of what does this mean, how the grossing up would be when there are slab rates and any other issues that may arise. And most important of all, I think no deduction. That's very important, because when computing the salary income, there is no deduction of expenses allowed to a person in terms of computing the salary. And I think that's probably going to be the only head of income where you would see such a treatment. And given the relationship between the employer and employee, and given the relationship of the employment, you would see that this is a very general principle that you would see on salary across the jurisdictions, not just Pakistan, but in India as well, in other jurisdictions as well. I see. Before moving on, I see there are people who have raised hands. So uh, I think I will call upon those. So just one house rule. Once I conclude this session on the salary, I will pause for a quick question answer session, and then we will move on to the next session. So I have noted your questions and your hands being raised, but once I conclude the session, then I will come to you, and then obviously we'll take your questions and respond accordingly. So just bear with me on this. Thank you. So so one of the most important things that one need to understand when computing the tax on salary is that the salary is calculated on the receipt basis. So what that actually means is that you should account for your salary income in a year in which you have received. And by year here, I mean a tax year. So if, for instance, you are, let's say, receive your salary in the month of August, but that salary actually pertains to the month of June, which obviously would fall in a previous tax year. So you should be able, you should account for salary in the month of August, or in the month or in the year in which the August would be falling. So let's say if it's June 19 to which the salary actually pertains, but you are being paid in August 2019. So that's basically tax year 20. And but it pertains to tax year, the salary pertains to tax year 19. So as per the provisions of the law, you should account for your salary in the tax year 20. And the second most important fact of chargeability is that it doesn't matter whether an employer or his or the employer's associate pays the amount, or whether an employee or an associate of the employee receives an amount on account of salary. This will be considered as the salary being received by an employee from the employer, whether that flows from an employer or employer's associate to an employee or employees associate. That will be considered as the salary being received by an employee from the employer. So these are the different concept or general principles that one should account for when computing salary. Now, moving on to a general category of a component or general component of the salary is perquisites. Perquisites, as I said earlier, it's the benefits which flow from employer to employee, and there are various kinds of perquisites that have been accounted for under the provisions of the Income Tax Ordinance 2001. In particular, Section 12 of the Income Tax Ordinance deals with what the perquisites are. And then when we go to Income Tax Rules 2002, those rules have also catered how the perquisite should be accounted for, and how a fair market valuation of these perquisites should be accounted for. So some of the examples of the perquisites will be a motor vehicle that an employer provides to the employee, whether wholly or partly for private use. Partly for private use, partly for business use. So that will also be taken needs to be taken into account. Then any services of a housekeeper, gardener, domestic assistant, uh, uh, salary paid by the employer on behalf of the employee to those driver, gardener, or domestic assistant. Right. Similarly, any utilities, provision of utilities provided by the employer to the employee, any loans. We will come to that in a short while as well. Loans provided by the employer to the employee, and we will see how the benefit of loans will need to be taken into account when computing the salary income. And similarly, any obligation that the employer would discharge on behalf of the employee would also be considered as perquisite within the meaning of the tax law. So, and any waiver of any liability that the employee has towards the employer, the waiver of such an liability would also be considered as a perquisite for the salary income computation. And then we will see accommodation or housing provided by the employer to the employee, and that's also a very important factor that needs to be considered when computing the salary income. Moving on, the first of the benefits, the first of the perquisites was the motor vehicle and how that should be accounted for. So you would be familiar that a lot of employers have these provisions for their employees, where they would give them a motor vehicle, car, or other mode of conveyance, and obviously the tax law has considered this as a benefit flowing from the employer to the employee, and have prescribed a method that how one should need to account for these provisions when computing the salary income. For instance, if a car has been uh, uh, purchased by the employer and then subsequently has been given to the employee for only personal use, then as per the Income Tax Rules 2002, the employer or the person enjoying the benefits of the car or the motor vehicle will account for 10% of the cost of the vehicle at which the employer has bought the vehicle in its salary income. For instance, if an employer bought a car for 1.5 million, right, and has given it to the employee for personal use only, then 10% of 1.5 million would be 150,000. That will need to be accounted for when computing the salary income. Accordingly, if it's partly for personal use and partly for official use, then the person who is enjoying the benefits from the employer as an employee will need to account for 5% of the cost of the vehicle to the employer. In the earlier example, if it's 1.5 million being the cost of the vehicle, then 5% would be 75,000 rupees that would need to be accounted for towards the salary income for tax purposes. However, the same goal would go if the employer has leased the car, right? If it has leased the car, then in case of the partly used for personal and partly for official use, then 5% of the fair market value of the motor vehicle would be accounted for towards the salary income. Similarly, if the car is being leased and it's being given to the employee for personal use only, then the 10% of the fair market value would be accounted for towards the salary income. However, if it's only for the official use and not for the personal use, then there would no provision, or there will be no accounting for in terms of the salary income of the employee for that particular tax year. So I think I can because I believe that a lot of there are going to be a lot of different concepts. So I can pause for now, and then I can quickly take the questions that you have, and then we will move on to the employee share scheme and other concepts, because I think we have already covered too much, and it would be appropriate to respond right now. So if there are questions. So there are a lot of hands raised.
Yes, Farhan, I have flagged 2 questions already, and they're both about, one is about medical allowance. I can read those questions out, and then there are a couple of hand raises also, and then we can head for those. So very quickly, Muhammad Arsalan Naseem is asking, if company pays for children education, is it part of salary? But other way around, if employee pays and claims for reimbursement, then it is not. Is that correct?
No. There may be some benefits that we will see, but if it's for the personal, if it's a reimbursement from the employer to the employee on account of the educational expense of the children, then obviously this will be counted towards the salary income of the employee. There are certain exceptions, and we will go through in a short while through that exceptions as well.
Okay, thank you. The other question is about medical allowance. Is medical allowance taxable where employer has arranged insurance, not for routine checkup or OPD?
We have also covered this in the couple of in next few slides. You will see that we have discussed this in detail. But just I think short answer, it's yes. If there's only medical insurance, then there is a exemption available. However, it's if the medical facility is in addition to the medical insurance, then medical insurance would not be considered as exemption, and instead it will be counted towards the salary income of the employee for that particular year.
Okay, I think I'll take this opportunity to let every participant know that you have to wait for the content. I mean, because Farhan has a lot in his slides. If you're trying to preempt questions, then probably detract Farhan from the course. Whatever has been explained, please limit your questions to those. Farhan, would that help? Yes?
Yes, absolutely, absolutely. I think a lot of people would have a lot of questions because this is a very personal topic when it comes to salary.
True.
So
True.
that's why I can anticipate a lot of questions on this topic.
Okay, so two very quick questions again, and feel free to call a skip if the question is to be addressed in your future slides. Just simply skip that question. But I'll
All
just
right,
put it forward. So Anas is saying, will the car benefits count as one-off event in salary income?
no, this will not be a one-off event. This will be a yearly event.
A yearly event. All right. Alina Wadood is saying, will bonus will also be counted towards salary? Right?
Yes,
Question mark.
yes, yes. It will be counted towards salary.
Okay, now there are a couple of hand raises also, and if we have time, we can. In fact, Alina has once again raised her hand, but then let's very quickly let Suleiman Simab ask the question. So I'm unmuting Suleiman. Suleiman, you have been unmuted. Please unmute yourself and ask a quick question.
Okay, I want to ask about the rent. In the constituent elements of income from salary, point C, you have said that any amount or allowance received in respect of rent is also salary income. I want to ask
Yes.
specifically about the public sector employees house requisition by the federal government if they are serving in the provincial or federal capital. So, if a person is living in his own house, even then federal government is paying rent to that person. That person actually rents out a house, even then government is paying rent to that person. How will we treat that rent amount? Will it be part of salary income, or it will be taxed to the person to whom the payment is being made? I mean, right now, if your government is paying directly to the third party, they are charging rental income from the third. They are deducting tax on the rental income of that third party. They are not charging it as salary income.
So yes, there are certain exceptions to the government employees, and I will get back to you on this, whether in respect of rent, there is a particular exception available to the government employees, because there are the government employees are being specially catered for when it comes to exceptions or exemptions and the salary income. The second part of your question is very important as well, because it would certainly relate to the private employees as well. So when a person leases out or rents his own house to the employer, and then employer subsequently leases it back or provides it back to the employee. So there are two elements involved here. One is the salary benefit that's being flown from the employer to the employee, and then there is also a component of the income from property of the employee, and that will need to be considered separately. And you will see shortly when I come to the housing or the accommodation allowance and how it should be accounted for, that this needs to be considered as well, because at one hand this would be your salary benefit, on the other hand this would be your income from property.
So wouldn't it get charged twice if we consider it both ways?
Sorry, I couldn't hear you. Your voice is breaking down.
Sorry, I was asking, wouldn't it get taxed twice if we consider it both ways as a part of
Your
salary?
voice broke down again, Suleiman. Sorry.
Actually, I was asking if we could consider that income for salary income as well as rental income, wouldn't it get taxed twice? It
So,
get
here's the thing. Yes, in essence, it would be taxed twice, but if you consider that there are two benefits being accrued, right? One benefit is of the income from property. The other benefit is of the salary benefit.
okay. Thank you.
Thank you. And I will get back to you on this during the break on this particular question that you asked, whether there is a exemption available for the government employees when the rent allowance or the rent is being uh, or the housing being provided to the government employees. All right, I think Harun sir, we can stop here because I can see a lot of people have raised their hands. So we can move on to this to our agenda, and then we will
Sure.
come back to further questions.
Sure. Yes, go on.
Second thing that would fall under the perquisites making part of the salary is the employee share scheme, right? Employee share scheme is basically it's a scheme under which the employer would allocate or would give a right to its employees to subscribe to the shares of the company at a subsidized rate or at a reduced rate, or probably at no cost as well. So again, this is a benefit that's being provided by the employer to the employee. So that's why the provisions of the tax law have very particularly accounted for these. So one thing that one should remember when accounting for the employee share scheme and the benefit for computing salary income is that such a benefit will have to be accounted for towards the salary when the person is entitled to transfer those shares, not when the person is entitled, merely has the option to subscribe to those shares or to purchase those shares. So that's why the value of shares should be chargeable at the earlier of the time the employee has a free right to transfer the shares or the employee disposes of the shares, right? Because if you dispose of the shares before you have the free right to transfer the shares, then actually you would be disposing of the right to or the option to subscribe to those shares, not to those shares as in particular. So that's why it's very important to remember when one should account for the employee share scheme benefit in computing the salary income for the tax purposes. Accordingly, the disposal would also need to be accounted for. Gain on disposal of the right, as I said earlier, or the right or option to subscribe those shares will be considered towards the salary income. However, when you dispose of the shares, then it would not be counted towards the salary income. Rather, it will be accounted towards the capital gain, which we will discuss at the end of today's session. So we will have further opportunity to discuss this when I open the floor for question answer session. I hope I'm anticipating a lot of questions on this one. Moving on. All right. So I've also included this example for the sake of explaining the employee share scheme benefit. Let me just come back because I think, yes. So Mr. Weasley has been the Chief Financial Officer of Hogwarts Limited for the last 5 years, and he was offered 5,000 shares on 1st June 2019 by Hogwarts Limited. It's not supposed to be XYZ Limited, it's supposed to be Hogwarts Limited, at a price of ₹5 per share. The market value on that was ₹15 per share on the 1st June 2019. The shares were transferable on completion of 1 year of service from the date of issue of shares. The market value on 1st June 2020, the year from the right to subscribe was available, is ₹200 per share. So there are two things that in this example we need to account for. The first question is, will there be any effect on the salary competition because the the right or the option to subscribe to those 5,000 shares has been granted in 1st June 2019, but they are not transferable, they are not disposable at the moment. So as I said earlier, if you have only the right to subscribe to those shares, the benefit would not accrue. So accordingly, the benefit, there would be no impact on the salary income in the tax year 2019. However, since Mr. Weasley would have the right to dispose of their shares within a year, that would be 1st June 2020. This means that on the 1st June 2020, there will be a benefit that would be accrued to Mr. Weasley, and Mr. Weasley would be required to account for this benefit that has been accrued in that tax year. And how Mr. Weasley would account for that tax for the benefit? Well, it's simple. On the day the shares become disposable, or he has the right to dispose of those shares, we will compute the market value on that day, which is rupees 200. 200 multiplied by 5,000, it becomes 1 million. And we will reduce any cost that is being paid, or any price that is being paid by Mr. Weasley to Hogwarts Limited. 5,000 into 5, because 5 rupees he was given the option to subscribe 5,000 share at rupees 5 per share. So we will deduct the cost of shares being paid by Mr. Weasley from the market value of the shares, and we will come to the conclusion of the benefit that has accrued to Mr. Weasley from Hogwarts Limited, and Mr. Weasley would need to account for 975,000 rupees when computing salary income. So I hope this would be a helpful example. Now, coming to this accommodation provided by the employer, this is also an important part. If there is a house allowance or there is a rent allowance, then that rent allowance would be considered as the benefit from the employer to the employee, and will be counted towards the salary income. However, if the employer is providing accommodation or housing to the employee, then the amount chargeable to tax under the head salary would be at the higher of amount that would have been paid in case if such accommodation was not provided. For instance, let's say there was a 30% of the basic salary that would be housing that would be considered as housing allowance. If that would fall under the category A, and 45% of the minimum of time scale of the basic salary, or the basic salary if there is no minimum of time scale. So first I will touch upon what the minimum of time scale is, and then will I explain this, and then I will come back to the whole category, because I think this is a bit complicated here. So minimum time scale is basically, it's sort of a scale that how an employee would be his base salary would be computed over the time. For instance, if in the example below you can see it's 250,000 base salary. The next 25,000 represents the incremental per year that would be counted towards the basic pay, and then 450,000 that you see towards the end it's basically the limit or the maximum amount that can be reached through this minimum time scale. Obviously, it can go beyond that, but for the purpose of accommodation benefit, for the purpose of this housing allowance, this is how the minimum time scale would be computed. So 45% of the minimum of time scale of the basic salary, if there is no minimum time scale, then the basic salary would be 45% of the basic salary would be considered for this particular purpose. So let me repeat myself, because I think it's very complicated here. So if the employer is providing housing allowance or the rent allowance, for instance, let's say employer gives just simply 20%, 20,000 or 30,000, then that would count towards the salary. However, if there is no allowance, fixed allowance provided by the employer, rather the employer provides accommodation or housing to the employee, then uh, while computing the benefit that has accrued to the employee, the maximum amount that either would have been paid if there was no housing allowance, if there was no housing being provided, or the 45% of the minimum of time scale, a minimum of time scale of the basic salary or the basic salary, that would need to be accounted for. I think this would be further elaborated with the example below, where you can see that there are three facts given in the example below. The minimum time scale is at the time 250,000 in the year one, right? Basic salary 140,000 per month, and the bonus 1 million per annum, and free accommodation whose rental value is rupees 1 million per annum. So how will we sort of compute? Well, first we would take into account the basic salary, would multiply it with 12, 140,000 per month into 12 would be 1.68 million. Then somebody, as earlier, asked whether bonus would count towards salary. Yes, bonus would be considered as part of the salary, and that will be included in the salary, taxable salary portion. And then the accommodation. So if you go up the value of accommodation, either it's 250,000, which is the basic pay on the minimum time scale, multiplied by 12, multiplied by 45%, or rupees 1 million, which is the the fair market of the rental value. In other terms, that is the amount which otherwise employer would have paid to the employee had he not provided such housing. So since we are supposed to account for the higher of these two, and 1.35 certainly being higher than the 1 million, so we would, when computing this taxable salary in this particular case, for accommodation, we will take into account 1.35 million, and the total taxable income after adding these three components would be 4.03 million. So moving on.
Farhan, if I can interfere here, we need to give our participants time for prayers. So it's 5 to 7. Can we give them time till 5 past 7 for their prayers?
Sure, we can. Let me know how, for how long are we going to be away?
10 minutes, starting
Right.
at yeah, 10 minutes. So we'll leave the session as is. We'll just put ourselves on mute and come back at 5 past 7, if that's all right.
All right. All right. Yeah, that's fine. That's fine. So we will be back at 5 past 6, right?
5 past 7.
5 past 7. Sorry, 5 past 7. Right. All right.
Yeah.
All right. That's fine. That's fine. Thank
All
you,
right.
Hamza.
Thank you. Thank you very much. So Farhan, if you're back, we could resume. I have flagged some questions regarding the case that you had described, Mr. Beasley. If you could.
Yes, Hamsab, I'm back.
Look at those
Yes, I
for a
think
minute or
we can
so.
take those questions. Yes.
Sorry, Farhan, are we waiting for something?
Sorry, we are not. I'm sorry. Are we resuming right now, or are we taking questions and then we will move on to the next part of the session?
I was questions or
So, sorry, Harun sir, actually your
okay?
voice is
Let's go with
loud.
questions very quickly. And may I request? Um is this any better now?
Yes, that's better. That's better. Thank you.
Okay. So a few questions that I have marked. This question is from Bhutan. It says, in the illustration, higher amount of house accommodation has been included in taxable income. Why is it so? Because if employer is paying lesser amount, shouldn't that be included? Sorry if I missed out on something as I joined late. I think the description you mentioned was that the higher amount will be included.
Yes, the law has prescribed this mechanism that whenever the employer provides housing to the employees, then there is a prescribed procedure or mechanism for accounting for such a benefit. I agree that the employer may or may not be paying lesser amount than the actually being accounted towards the salary income. But since that's what the law has prescribed, I think the law has prescribed.
One final question is Jaz Mazhar is asking, can we adjust refundable income tax as payers in tax returns against salary tax?
Yes, certainly. So the idea is that when we are computing at the end of the year, when we are filing our income tax returns, we compute our tax liability, and then certainly if we have any benefit, any refunds from previous years, then we can adjust against those tax liability, whether that being only salary income or not. I think that would not affect the treatment or the benefit to adjust your previous year refunds.
That's all, I think. And if we can resume, Farhan.
All right. Thank you, Harun Sab. So next benefit or perquisite forming part of the salary income is this facility of loan that's provided by an employer to its employees. As you would be familiar that a lot of employers have these different benefits for their employees. They provide all these subsidized loans. So law certainly has catered for that event as well. So basically, as per the provisions of the income tax ordinance and the income tax rules, uh, whenever an employer provides its employee with the interest-free loan or a loan at a reduced rate, then any benefit. So I will come to what the benefit would be in this context. Any benefit will need to be accounted towards the salary income for tax purposes. So the benefit in this context would be that, let's say, if the benchmark rate, for simplicity for today, benchmark rate is 10%. Going forward, it's 10%. We will come back to why it is 10% or how is it fixed. We will come back to. For simplicity, let's say the benchmark rate is 10% of interest, but the employer provides loan at 2%. So there's a differential of 8% that is the benefit that's being accrued to the employee from the employer, right? Similarly, if it was an interest-free loan, then the benefit would be what? The benchmark rate, because there is no interest rate being paid by the employee. So the benefit in this context would be the differential between the benchmark rate, that is 10%, and the interest rate at which the employee would pay interest to the employer against that principal amount of the loan. Now, so why benchmark rate is 10%? So basically, when this provision was first introduced in the income tax ordinance 2001, the benchmark rate for that year, the tax year 2003, was prescribed to be 5% and would be increased by 1% uh, for each successive year. So therefore, there's very clear, because and it can go only up to 10%, and beyond 10%, it will not exceed 10%. So if it was 5% on tax year 2003, then on tax year 2009, it would be 10%, and any year beyond the tax year 2009, it will remain to be 10%. That's why for today, in today's time, the benchmark rate would be this constant 10%. Also, these provisions or the benefits would not would not need to be accounted towards the salary income when the loan amount is for rupees 1 million or less than that. It only applies if the principal loan amount is more than 1 million rupees. And another important factor is that any such loan that is being taken from the employer and the benefit is being accounted towards the salary income, if that loan is being used, let's say, to buy some house, to buy some property, and then a rent or the income from that property accrues, which we'll go through quick in short while. If any rent or benefit accrues from that property, so when computing income from property from that particular property, then such a benefit, the benefit plus any interest that has been paid to the employer would be considered as a deductible expense for the purpose of computing income from property. So these are two or three different important factors that one needs to consider when computing when availing these interest or reduced rate loans from their employers. So another important benefit that can flow from employer to employee is the provident fund. I'm sure if any of you is working or is employed, then you would know that some of your employers may be providing you this facility of provident fund where a particular amount is being deducted from your monthly salary, and then obviously the employer also makes a contribution equal to that amount that's being deducted from your salary, and that goes towards the provident fund, and it has its own implications. So there are basically three types of provident fund in general categories under the tax law, income tax law. One is government provident fund, the other is recognized provident fund, and the third is unrecognized fund, provident fund. So government provident fund, by its very name, it's clear that it's a provident fund that has been set up by the government, and the government simply deducts from its employees, excuse me, deducts provident fund contribution from its employees and make an equal or almost equal contribution to the provident fund. Recognized provident fund and unrecognized provident fund has a very specific definition under the Income Tax Ordinance 2001. So basically, recognized provident fund is the one uh, uh, that has been set up with the and has been recognized by Federal Board of Revenue. That is one of the tax collecting authority or the federal tax collecting authority that we discussed in the last session. Accordingly, unrecognized provident fund would be any provident fund that has not been recognized by the Federal Board of Revenue. So all these three different types of provident funds have their own implications in terms of the benefits, how the benefits should be accounted for towards the salary computation and the tax liability thereof. So one thing that you will see constant in all these three provident funds is that employee contribution, there is going to be no treatment. Why? Because it has already been accounted for in the salary income. So that would amount to double taxation if it's being taxed again, if the employee contribution is being taxed again. Accordingly, there would be in the government fund the employer contribution that will be exempt. There would be no treatment on this, and it would not needs to be accounted towards the salary income of the employee. However, for recognized provident funds, for simplicity, we can say these private employee provident funds. For simplicity, of course, in nuance, this would have its own implications. There's a limit on to the extent of employer contribution. Only the 1/10 of the basic salary plus the dearness allowance, or 150,000 rupees, whichever is lower, would be exempted from the salary, would be exempted from tax, and any amount exceeding that would be accounted towards the salary income for tax computation. For instance, let's say your basic salary plus dearness allowance amounts to 50,000 rupees, and your employee deducts 5% of both. So 50,000, 5%, or let's say 10%, just to keep the calculation simple, 10% would be 5,000 rupees. So 5,000 into 12, that would be 60,000 rupees. And since it has to be 150,000 or 60,000, lower of the two, therefore the 60,000 would be exempt from the taxable income. It would not be accounted towards the taxable salary income. However, if the amount, let's say, exceeds 150,000 for the year, then that excessive amount will need to be accounted towards the salary income of the employee. However, if you see against the unrecognized provident fund, there is no treatment on the employer contribution. But we will quickly get to know why there is no treatment on the employer contribution while there is when it comes to unrecognized provident fund. But there is a certain tax implications when it comes to recognized provident fund. Interest, again, government provident fund, there is no treatment. It will be considered as exempt from taxable income. No need to account this towards the salary, taxable salary. However, if the recognized provident fund, if there is any interest, then obviously, again, just like the employer contribution, there is a bar on to what extent the interest will need to be accounted for. So the only 16% interest rate on accumulated balance, or 1/3 of the basic salary plus dearness allowance. Again, if your accumulated balance is, let's say, 100,000 for the year, and for the year your interest increases exceeds this limit, then the excessive amount will need to be accounted towards the salary income for tax purposes. Again, there is no treatment for unrecognized provident fund. And now we come to why. Because when there's no employer contribution, there's no treatment on the unrecognized provident for employer contribution or interest. However, when the employer makes payment to the employee for from this unrecognized provident fund, at that time that amount will need to be accounted towards the salary income. However, if you see, at that point no benefit will need to be considered for taxable salary income under government fund or the recognized provident fund. So that's why there was a somewhat different treatment in the second and third row, and you would see why in the fourth row you would see why there's a different treatment. Now, moving on, somebody had asked for the medical benefit or the allowance. So, so this is the slide that deals with that. So basically, if an employer provides this medical facility or for hospitalization charges or medical charges, uh, or the employer reimburses those charges incurred by the employee, then that will be considered as exempt, and that benefit will not be considered for computing the taxable salary, right? Similarly, if the medical allowance is provided, then this would need to be considered as uh, uh, only up to the point of 10% of basic salary will be exempt, and any amount exceeding any medical allowance exceeding 10% of the basic salary would need to be considered for computing this taxable salary income. However, there is a bar on that. If an employer both provides a medical allowance as well as this facility for hospitalization or medical charges, then only that medical facility or for hospitalization charges would be exempt, and medical allowance in that case would not be considered as an exempt and will need to be counted towards the taxable salary and the tax liability there. Now, yeah, in the interest of the time, we're probably not going to have enough time to go through the rest of these exemptions. However, I've just quickly highlighted these different exemptions that are available to employees. I would just quickly go through one, because someone had asked regarding the medical expenses, or sorry, not medical, the education expenses, whether that's being paid directly by the employer or being reimbursed by the employer to the employee. So there is an exception to that, and that exception comes under this certain perquisites received by an employee by virtue of employment under clause 53 of part 1 of the second schedule. So basically that particular clause says that if an educational institution provides free of expense education to its employees' children, that will not be considered as a benefit or the taxable benefit accrued to the employee. The reason being that the institution, the employer, did not have to incur any additional marginal cost for the purpose of providing that benefit to its employees. Accordingly, if a hospital provides any such benefit, uh, any free of charge medical treatment to its employees, then that would also be considered as exempt for the purpose of computing taxable salary. Uh, so you can, if you have time, you can quickly go through that as well. For your convenience, for your reference, I've included these different benefits or exemptions available under the law. Now, the last part would be the tax rates. As you can recall, in the last session, we had said that there are tax rates for the slab rates for salaried individuals and other individuals and association of persons. So one thing that one should consider, what is salaried individual. So basically, a salaried individual is one whose income from salary constitutes 75% or more than that of his or her total taxable income. So for instance, let's say your total taxable income for a year is 1 million, and you have salary income amounting to rupees 900,000. That's 90% of your total taxable income. That means you will be considered a salaried individual, and these are the rates that you can see on your screen would be applicable. And the first slab starts from rupees 600,000, and the last slab starts from the 75 million rupees. So these are different slabs. I hope you would be familiar with how to use these slab rates. I often get this question from my friends that they are just scared, or their salary is 1.8 million, so they would have to pay 15% on the whole 1.8 million. That's not the case. If you, for instance, see the tax slab between 1.8 million and 2.5 million, that clearly says rupees 90,000 plus 15% of the amount exceeding 1.8 million. So basically, each slab has its own rate, and any income falling in that slab rate would needs to be applied to that slab, not to the whole taxable income. I hope that would clarify your questions. If you, I was anticipating this question. Then for those individuals or association of persons, individuals not considered as salaried individuals and association of persons, they have different slab rates. And the first slab is between rupees 1 and 400,000. And then the last slab actually starts at rupees 6 million. And you can see that any amount exceeding rupees 6 million would be subject to 35% of the tax, and plus rupees 1.22 million. So this is first part. I think we can take a pause here, and I will open the floor to the for questions, and then we will move on to the next part, because I think we have very short time, but we will try to respond to those questions as much as possible. Harun Sahab, are you there? All right. So, Mr. Mohammed Anas Khan, so Harun Sahab, I have taken the liberty to actually go through the questions and respond. I hope that's fine.
It was me who would be looking after the questions, but I think there was something wrong with my mic and you were not able to hear me. Can you hear me now? Am I audible now?
Yes, 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 you are. You are. Thank you, thank you.
Okay. So can we start with Shakil Ali's question?
All right. So could you quickly go through the question, because I think I cannot follow the
Yeah,
chain.
I'll be doing that. I'll be doing that. Shakil Ali wants to know, it's a rather interesting question. He wants to know, can we deduct amount of annual subscription fees paid by the employee to its professional body for taxable income?
I think not. But this is a very specific question. My preliminary answer would be no. But if I find any other response, then I would certainly get back to you and give you clarity on this. But my understanding is not. It would not be exempt.
Okay, so the next question is there any type of tax applied on charitable institutes, for example, salary and any charitable asset the institution owned?
Uh, can you please quickly repeat your question? I couldn't hear it properly.
Sure. Bilal wants to know, is there any type of tax applied on charitable institutes, for example, against the salary that they're paying or the assets that they own, the charitable institutes?
Uh, s- uh, at this point, we are not discussing these charitable institutions. I think
Okay.
this would be covered under a different head. Uh, just one thing for clarity. If you're talking about the employees of these charitable institutions, then there are certain exemptions available to some of the charitable organizations, but those are very specific and has been prescribed in the second schedule to the income tax ordinance, and there's no general sort of exemption available for these employees.
Okay. So the next question is it's about the provident fund. If the interest paid by the employee is greater than the benchmark rate but less than the market rate, will attract tax benefit or tax cost?
So this will neither be if the bench greater than the benchmark rate but less than, there will be neither a benefit nor the tax cost to the extent of the employee. There will be
Okay.
certainly no benefit, and there will certainly be no cost.
Okay. I hope that would be suffice for Suleiman. Can we take a couple more questions?
Yes, I would request to quickly wrap it up, because I have two further sections to cover, and I think we have just left with a half an hour, so I would have to quickly wrap it up.
Okay, I'll just quickly go through the remaining. Uh, Alina and Suleiman wants to know what is dearness allowance, and unrecognized PF is not recognized by FBR. What does that mean?
So dearness allowance is basically, I think that can be any sort of benefit categorized in that manner. I think there's no particular definition as to what dearness allowance is, but I think at the time when this provision was probably introduced, they had this terminology included. So if an employer, for instance, has this dearness allowance, or classified an amount as dearness allowance, that would be considered as dearness allowance for the tax purposes. As far as the unrecognized provident fund means, it means basically that the income tax ordinance has prescribed this mechanism under sixth schedule, whereby they have uh, laid out a procedure how a provident fund would need approval from the FBR, from Federal Board of Revenue, for recognition. So if a provident fund does not apply to Federal Board of Revenue for recognition purposes, that will be considered as unrecognized provident fund. I hope that would clarify.
Okay. Uh, Ijaz is asking, rather confirming the answer. So the medical reimbursements either for OPD or hospitalization are exempt, provided that we have all the supporting receipts.
Yes, yes.
Okay. Next up is
All right. I think we can move on to the next topic.
I think we move on.
All right. Second head of income for today's session is income from property, and by its very name, it's clear what income from property is. That any income that one earns from property. So property here means immovable property. For instance, the rent received or receivable by a person uh, is chargeable to tax under this head. So excuse me. What does rent mean? So rent basically mean any sort of amount that owner of land or a building would receive uh, from a person to whom he has rented or leased out that land for the right to use or occupy the land or the building. And this rent would include any forfeited amount as well, a forfeited amount on account of sale of land or building. I think in local terms, this is called Biana. I'm not sure how many non-Urdu speaking people are there, but Biana basically means it's earnest money that's being given for an agreement to sell or purchase the land or building. So if that amount is forfeited for whatever reason, that will be considered rent as well. And important factor to remember is that whenever we are computing income from property and we are computing rent in that context, the fair market value of the rent will have to be considered for that purpose. Obviously, this becomes a very subjective thing. Uh, Whether there are enough resources available to suggest what the fair market rent would be in particular circumstances. But I think this question certainly would arise when it comes to transaction between two associate persons, because if if the persons are not associated, then I think the presumption would be that it's a transaction at arm's length. Otherwise, if it's associate person, then it will become a matter of concern whether a transaction between two associate person is an arm's length transaction or not. Similarly, unlike income from salary, there are admissible deductions under the income from property head. So not that you will be or one person would be taxed at the gross amount. Rather, one can deduct expenses, and there are different kind of expenses within limits that one can, for instance, deduct when computing taxable income from property. One example would be that if there's any repairs to a building, then an allowance equal to 1/5 of the rent chargeable to tax in respect of repairs would be allowed. What that actually means is that if, let's say, your annual rent is 1 million, so 1/5 of that would be rupees 200,000. So that 200,000 would be deductible, and any amount exceeding 200,000 in this particular set of facts would not be deductible as such. Similarly, if there are any insurances being paid, any premium being paid, then obviously that would also be considered as deductible allowance. Any mortgage being paid would also be considered as uh, deductible allowance. Any expenditure not exceeding 4% of the rent chargeable to tax. Uh, so that for there's a general sort of administration or collection expense not beyond 4% of the rent. So that limitation exists as well. Now, so one thing also important in terms of history. So there have been a number of experiments from the government over the period of 20, 30 years. How they first they tried to sort of introduce separate rates for income from property for salaried for individuals and association of persons, and separate rates for company. And but recently the legislature has removed this distinction, and now all persons, whether that individual or association of persons or company, they are taxed in the same manner across the board. There is no distinction anymore. One last thing before moving on is the treatment of non-adjustable amounts against income from property. So this particular provision has its own implication. For instance, one might think that the security deposit may be considered as under this, but there is a good argument that the security deposit is not should not be considered under this particular category. We will explain why or why not. And then there are other types of non-adjustable amounts in terms of the property that we will discuss. So basically, this particular provision says that if there is any non-adjustable amount is being paid by a lessee or to the lessor on account of rent of property, then that amount will be considered as part of the income from property and will have to be accounted for over the period of 10 years, including the year in which the receipt uh, uh, was made of this particular non-adjustable account. So just to put this provision in context, there's a concept of pagri amount whenever a commercial land or commercial property is being leased out. A pagri, I'm not sure what the English term would be for the pagri amount. So pagri amount would be just like the earnest money, but it's non-refundable, it's non-adjustable. So that would certainly be considered as income and would be made part of the taxable income from property. However, if any amount is returned before the expiry of 10 years, then any amount that has not been accounted for at the moment of refund of that particular amount, it will not be accounted in the income from the tax year. However, if the landlord, if the landowner or the lessor leases out that land in the same year or within the limit of the differential years from the 10 years, then he will, any amount subsequently received which will be non-adjustable advance would need to be accounted for towards the rent amount. um, I think there will be an example in this slide that would probably explain this non-adjustable amount further, that how this should be accounted for towards the income from property and the taxable income from property. So I've included these 5 examples that would give a brief overview of what we just discussed in the income from property. In the first example, you can see that Mr. Potter received rupees 50,000 per month during the tax year when the fair market rent of the property was rupees 60,000 per month. So if we look at the provisions of the law, it certainly says that the fair market value of the property would, fair market rent of the property would need to be considered as rent. So in this case, certainly rupees 60,000 per month would be considered as income from property, not rupees 50,000. In the second example, on August 2020, Mr. Dumbledore received rupees 345,000 as rent for leasing out factory land, building, and machinery. Now, this is an interesting example. This would not be considered as income from property. And why would that be? Excuse me. And why would that be? Because uh, the Mr. Dumbledore is not just leasing out factory or the land or the building. Uh, uh, the whole premise is being leased out, including the machinery that has been installed. And we will in the next couple of sessions, and we will see that this will be computed under the income from other sources, and it would have its own implications when this such an income would fall under the income from other sources. Third example, Hogwarts Limited owns a residential house and has provided the same to one of its employees for no rent. Fair market value of the rent was rupees 1 million. So that would certainly be considered as this would not be considered as the income from property. And why would that be? Because this is an example of income from salary, where the benefit would be considered under the income from salary, and the any cost in that context would be allowed, and we will go through in the next session when we learn how to compute the income from business. Fourth example, Mr. Longbottom received 2 years advance rent of rupees 1.5 million. Now, this is also important because the the income from property would only be computed on the accrual basis. That is for the particular year. If there is any advance amount for beyond that particular year, it will not be accounted towards the income from property. Rather, any excessive amount beyond that year will be accounted for in the next year to which that advance rent would relate to. Fifth example, Mr. Lovegood owns 75 acres of agricultural land in Mirpur. He did not cultivate the land himself, and during the tax year 21, he received annual rent of rupees 2.5 million from the tenant cultivating the land. Now, this is also an important exception to the income from property, and this will not be considered as income from property. And the reason being that this will be considered as agricultural income. And as you can recall from the last session, the agricultural income is a provincial prerogative, and certainly would be exempt from income under the Income Tax Ordinance 2001. I hope these different examples would clarify what we just studied for the income tax income from property. Now, before moving on to the capital gain, I would quickly open floor for the question answers. Feroz, are you there?
Yes, Farhan, I'm here with you. Okay, so let's see the question. Haris Ahmed wants to know if individuals having foreign source of salary income is chargeable to Pakistani tax. I think that is subjective if you are living in Pakistan, or whether in the country where you're receiving the income from. But Farhan could shed some light on that.
If you recall from the last session, we had said that any resident person would be subject to tax on foreign Pakistan source income as well as foreign source income. So that actually means that if you're in Pakistan and you can qualify for these resident person criteria, of course there are exceptions for short-term residents. So if you are a Pakistani having this foreign source income, that would certainly be subject to tax in Pakistan.
Okay. Mohammad Ans Khan wants to know what is the treatment of securities in property. Is it considered a fortified amount?
I, to be honest, cannot understand what the securities in property would mean. If Mr. Anas can sort of enlighten on what security in property mean, then I can shed light on this.
Okay. Until Ansh clarifies his question, we'll move on. Next up is Ahmed Sharif. He wants to know what is the treatment for taking own on property at the time of sale. I think that will be covered in capital gains. What if the property belongs to multiple members of the family? So the tax will be apportioned on the basis of rent received by each individual, or will be considered as whole.
So it can
Farhan,
be
did you get
both.
that?
Yes, yes, yes. I will certainly get back to you on this, but my preliminary answer is that it can be both. So that only one person can also account for the whole amount, or it can be apportioned to in accordance with the ownership structure of the premise that's being rented.
Okay, Wasif wants a final answer on, can you please clear the rent from agriculture property would be treated as income from property or not?
No, this will not be considered as income from property. Rather, it would be considered as agricultural income, and that would be subject to tax under the provincial legislation.
Okay, Hasib Azam Maiman wants to know, can you elaborate the tax implications on pagri rent system further? I'm not sure about that.
Can you Pagri rent system further? So Pagri basically was this non-adjustable amount that was paid by a tenant or lessee to the lessor. So since that's non-adjustable amount, the section 16 of the income tax ordinance has prescribed this mechanism that such a non-adjustable amount will have to be accounted for over the period of 10 years. So for instance, let's say you have received this pagri amount of rupees 100,000. So in that year, it will be accounted 1/10 of the amount would be 10% of 100,000 being 10,000 rupees, and then in subsequent year it would be 10,000, and then third year, fourth year, in each year up to the 10th year would be 10,000 rupees would be counted towards the income from property.
I think we can move on now.
All right. So this is today's last session, last part on capital gains. I would, given the short time that we now are left with, I will quickly go through what capital gains is and how to account for capital gains. So basically, capital gains is that any gain arising on disposal of a capital asset will be considered as capital gains. So there are three things to focus on what the gain is, what the disposal is, and what the capital asset is. So starting from the last one, so basically capital asset is uh, the way it has been defined, it's a negative definition, which means that anything that 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 does not sort of fall within these exceptions that has been provided would by default be included in the capital asset. So there are three exceptions that have been provided: stock in trade or consumable stores or raw materials held for the purposes of business. In other terms, this is an inventory that a business might hold, right? So this would certainly not be considered as capital asset. Any property with respect to which the person is entitled to depreciation or amortization, that again is a business asset, and this would also be not considered as capital asset, right? And we will of course go through this that how this will be accounted for if a business asset is being disposed of, then how any gain on that account will be accounted for. And third exception is that any movable property, barring few exceptions that you can see on your screen, any movable property held for personal use by the person or member of the person's family. So these are the three exceptions. Any property that does not fall within these exceptions would be considered as capital asset. Capital asset. So, for instance, let's say shares, they certainly do not fall within these three exceptions. Shares of a private company. Why I'm saying private company? Because public company shares, there's a separate treatment provided. For the purpose of today's session, let's say shares of a private company, they would be considered as capital asset. Now, if an individual owns a car, would that be considered as a capital asset within this definition? No. The third exception provides that any movable property held for personal use will not be considered as capital asset. So you can see that the car held by a person for personal use will not be considered as capital asset. Now, how the capital gain would be computed? So gain basically means that any amount that you receive, if that amount or consideration exceeds the cost of the capital asset, the cost that you had incurred in purchasing that capital asset, any amount exceeding that amount, that cost of the capital asset would be considered as gain or the capital gain. There's a formula appearing on your screen that how the capital gain should be calculated: A minus B, A being the consideration received on disposal, and B being the cost of the capital asset. Now, I think consideration has its own meaning, that how consideration will be computed, because if the consideration is higher than the fair market value, then the consideration would be then any amount received which is higher than the fair market value at the time of sale or disposal, that will be consideration. If that amount is lower, then the fair market value of that asset at the time of disposal will be considered as consideration for the purpose of computing the capital gain. Then one, I think important thing that one should consider is the holding period for capital asset. So for instance, if one person holds shares for more than 1 year, the capital gain would be reduced by 25%. And so basically that means that there will be 25% exemption up to 25% of the capital gain. And if the holding period for the shares, let's say, is less than 1 year, then the whole amount of capital gain arising on the disposal of those shares, of the private company, will be subject to tax under the capital gains. For immovable property, there are different holding periods that have been allowed. That's certainly a tax policy decision that the government has taken to incentivize these investments in the real estate sector. So if a person, let's say, hold an immovable property for more than 4 years, then such any gain arising on that particular property, on the disposal of that particular property, will not be subject to tax under the income tax ordinance. And then I will quickly touch upon the deduction of losses. So loss basically means the opposite of gain. If your consideration that you are receiving on the disposal is lesser than the amount of the cost that you had incurred while purchasing that capital asset, that would be considered as loss. So a loss for a particular for a year or in that year will be adjustable against the business income for that year. However, it can only be carried forward and adjusted in the next tax years against the capital gain in those years. And we will probably have a quick overview in the next coming sessions on how the losses can be carried forward, and we will or recap this part as well here. Accordingly, no loss will be recognized on disposal of certain capital assets. For instance, painting, jewelry, any postage stamp or first day cover. These, if a person incurs any loss on these assets, these will certainly not be recognized. What that actually means is that these losses will not be adjusted and will not be used against any income or gain arising from other heads of income or under the head in capital gains. So with that, I think we will conclude today's session, and I will open the floor for question and answers session. And if you have any question regarding the last part or any previous part, I'm obliged to respond.
Farhan, a question that I had been holding on for quite a while is Suleiman Samab's. It's quite comprehensive, so I'm going to request Suleiman to unmute himself and ask the question directly from you. Suleiman, you're in self mute. You can unmute and ask the question.
Okay, am I audible? Hello.
Yes.
Okay. The basic question is regarding federal government employees accommodation. Basically, the federal government employees have mainly three options regarding accommodation. Either they get house rent allowance, which becomes part of the salary income and get taxed as salary income normally. That is fine. Another option they have is to get a government owned accommodation for which they get they will not get house rent, which will reduce their taxable salary income. Further, they will also pay 5% of their basic pay, which will get deducted from their net salary. Third option is house acquisition or hiring. Hiring further has its further types: self-hiring or third-party hiring. The hiring, if you will get hiring, again you will not get house rent allowance, which will again reduce your salary income, gross salary. And the amount of hiring that you will get is based on what kind of hiring you're getting. I mean, if you get a house rented from a third party, then the government will pay rent directly to that third party after deduction of withholding tax under section 155 on the rental income. If the house is owned by the employee himself or the employee has power of attorney to collect the rent, then the government will pay rent to that employee, again deducting the withholding tax under section 155 on the rental income. That's how government treats. My question is, in the first two cases, I mean, in case of HRA, it becomes part of salary income and gets deducted. Normally, it's fine. In case of government-owned accommodation, the employee is neither receiving HRA nor instead he is paying the rent of 5% of basic salary to the government. What about the hiring? How will we treat it? If the person is getting rent from the government as part of self-hiring, or if the government is directly paying to the third party, what will be the treatment? Because right now the government is treating it as a rental income and not as a salary income.
Suleiman, I think this question would certainly require a lot of, not a lot of, but somewhat detailed answer. So what I can do is that I can, given that we are already
I think Farhan lost his audio. We'll just wait a couple of seconds for him to join back. Farhan, are you on the call?
Yes, yes, I am on the call. Uh, did
We
I
missed
like my
some part
voice?
of Yeah, we missed some parts of your answer. Just can you repeat that?
So I was just saying that this question would certainly take our time. And what I can do is that I can respond to this question in writing through you. And then obviously you can circulate the answer to Suleiman if there is any way to circulate that answer. And then if otherwise, what we can do is that in the next session, in the first 5 or 10 minutes, we will quickly discuss this in detail because we are already past our scheduled time. So I think it would be beneficial if we can sort of respond in the next session or in writing before that session. I hope that's fine.
Yeah, that's fine. That won't be a problem. So there are only two questions. We'll quickly get those off the screen. What will be the treatment if a person have gain on coins or antiques?
So
Would
if
that
you
be considered
see,
as capital gain?
yes, that will be considered as capital asset if you see there were three exceptions, and within the last exception or the third exception where it was said that movable property held by a person for personal use, but there are exceptions within that exception, and one of those exception says that these coins or antiques will not be considered as movable property within that exception. The consequence of that would be that it will be considered as capital asset. That's why gain on those antiques or coins will be considered as capital gain.
Okay. One last question. Tax exemption of medical allowance of 10% is still applicable in case company have medical insurance policy.
In case company have medical insurance policy too, I think not. Because if there's a medical insurance policy, then the medical allowance would not be exemption on medical allowance would not be applicable. However, I would certainly get back to you on this if there is if I find anything otherwise.
Okay. Thank you for the answer, Farhan. And Suleiman, let's just keep that for the next session. And Farhan, would you like to explain about the task that will be that is going to be assigned for the unmoderated session? Can you explain
Yes,
something about that?
I think
Thank you.
an exercise handout has been circulated. So what I've tried to do is that I've tried to test two concepts in particular: capital gain and the salary, income from salary. So there are different examples or facts being set out in that exercise. What I would suggest is that before doing that exercise, what you can do is that quickly go through the slides that have, I think, already been circulated, and then jump onto that exercise. Because what will happen is that your sort of understanding will be revised, and once you go to that exercise, you will see that your concepts or your understanding will actually be tested. So I think that would be helpful if you go through these slides prior to the exercise just once, and then attempt that exercise. That will be helpful.
Perfect. So I would like to request you all to keep in mind, stay focused on the topic and not to ask questions that are not relevant to the topic that is being discussed, because we cannot keep on holding the trainers for quite long and asking questions from the irrelevant section. It certainly means that we are losing some time. But if the question is not addressed in the relevant topic, we can always take it to the trainers to answer these questions. So let's see you guys tomorrow. The handout section, it contains session 2 tax computation part 1 and exercise session 2 tax computation. You guys need to download both of these and use these handouts for the task that is assigned by Farhan for tomorrow's unmoderated session. So we'll see you guys tomorrow in the unmoderated session. Thank you so much, Farhan, for your time. Thank you so much for staying past the clock. And we will see you guys on Monday for the next session. Thank you,
Thank you,
Farhan.
Feroz. Thank you, everybody. And I just want to say that if I sound exhausted because it's past 8 and I'm still in the office and it's Friday evening, so my apologies if I had any vibe of an exhausted person going on. I've tried my best to respond to the questions as much as possible, and for those questions that I've promised to look up and will get back hopefully before the next session. So thank you very much, everybody, for bearing with me for these 2 hours. Thank you.
Thank you so much, Farhan. Thank you.
Thank
See
you.
you in the next session, everybody. Bye bye.